in this episode, I'm going to come back to something that's been bothering me for a little while when you think about the words that we use to describe what we do. And we talk about a market. Now, it's probably older school, like what my grandmother used to say, but when she said she was going to the market, she'd go to the shelf and she'd buy the bread and she'd buy different things on the shelf. And so when I think about the market, it's hard to think about that. And so especially now, whether you're calling your broker or whether you're trading something online, it's still hard to think about that as something where there's inventory and you're buying something that's on a shelf and then it comes to you, because in the end, you don't really ever hold it. And so I think what we're going to try and do in this 101 on EFG Wealth Management Israel is to kind of just put out there what products are, what they mean, maybe some of our experiences in seeing how they work and what they do to the people who buy them, not do to them, but how, how they've accomplished the goals of the people that buy them, and what you should be considering when you hear all of these different high level topics or products that we say in the banking world. But I think it might make sense to answer one question before that, which is, here we are sitting in Israel, and we talk about Swiss, and we talk about opening up accounts in Switzerland. Why is Switzerland such a big market for these products that we're going to dive into?
I think Switzerland has been developing across many, many, many years a certain expertise about banking, advisory, portfolio management, and this expertise has been evolving over time, which makes it now one of the, I would say, most specialized countries for wealth management. And that is something that is always in people's mind and attracts people from all over the world. I mean, if you also look at the amount of wealth that is managed out of Switzerland, it is phenomenal. I don't have the exact number here, but it is a huge amount for such a small country. Eventually, I would say also today, we're not talking about this banking secrecy as we used to like in the past, but still the population, the whole ecosystem that is working around the banking services in Switzerland is phenomenal. If you walk around in Zurich or in Geneva, most of the people you will be meeting are working for banks or financial institutions, whether it is relationship manager, investment specialists, advisors, portfolio managers. That is phenomenal. And that whole ecosystem is making it like extremely efficient for people to work with. And Switzerland is working with the whole world in terms of the different, in terms of regulations, in terms of offering. This country, the banks in this country are have the ability to work with all kinds of jurisdictions, and that is also very, very interesting. So I would say that the product offering has been evolving over time. It's extremely diverse. It's extremely wide. It's extremely sophisticated, and that is very appealing to clients from across the world, really.
So you're coming to a superstore, is what you're saying?
Yeah, exactly. A superstore with a lot of capabilities, a lot of offering. It is something quite unique in terms of wealth management.
So let's list a few standard products that everybody knows. We can maybe joke around a little bit about them, but we'll explain a little bit about what they do and what the purpose of investing is. So first one on the list.
Yeah, well, I mean, you got the basic, what we say, the plain vanilla stuff like stocks and bonds, like most people have heard of. You can buy, stocks to buy shares in a company, or you can buy bonds to get exposure to company's debt, and then you get a, income from that. This is what we call it fixed income. But some people need to be aware of what we call concentration risks. If you put you don't put all your eggs in the same basket, and therefore when you buy a few stocks, all of a sudden you realize that it represents like a big proportion of your portfolio, and therefore there are instruments which will allow you to invest in more diversified stuff. So like ETFs, which is exchange trading funds, it's like passive investment, just replicates like what we call an index, a bunch of stocks, but it just replicates the performance of it. Or you have funds, which is you're paying a manager to to get to manage a portfolio of stocks or of bonds in a certain category, and but it just like gives you in one instrument exposure to many stocks or many bonds. So that's just like very very basic, I would say, explanation. So those are the basic stuff which you can get access to very easily.
And I would say here, I think you touched on it. Just let's remind people, stock, you own the company. Bond, you've lent to the company.
Yes.
ETFs are really interesting. One of the biggest moves we've seen in investing has been this move from active to passive. And I think if you come back to our last conversation, discretionary versus advisory. You buy a single stock, you buy a single bond, you do stuff like that, you are advising yourself. That's an advisory portfolio. In an ETF or a mutual fund, what you're doing is you are allowing somebody else, you're looking for broader exposure. And so the reason people come into these types of instruments is to get broader market exposure. Now, we're at a really interesting presentation at the Global Summit that our investment team did in London last week, and we had a guy come out there and talk about some of the trends in ETFs, and it's something that you can hear on almost any, if you follow the financial markets. Some of the ETFs out there are not just getting you exposure to the top 10 themes in technology. They are actually allowing you to use leverage. And so some of these ETFs are not as, they're not really, they're becoming a little bit more risky, I would say, might be the right word. And they're allowing you to invest in almost any theme you can think of. And so I think one of the things that's, you take these standard product, as they evolve, they start to touch a much broader piece of the market. And as a buyer of this product, you really should be careful about what you're looking at. And
Exactly.
so ETFs is a very broad category. I think the advantage, and this is not advice, the difference between an ETF and a mutual fund in part has to do with tax consequences. It's the way things are sold. It's the way things are bought and sold. And when you want to get into the differences between them, you have to look pretty carefully. So standard product, I would say, is the basic building block of almost any portfolio. And the truth is, this is where most of our investors start their investing careers, is by taking a look at things like this, either funds, individual stocks, individual bonds. And then you can get into different categories. And so if I told you what's the difference between a AAA bond and a CCC bond, you could start to, that's where you start, or a corporate grade bond and a high yield bond. Obviously, there are different nuances here. And the more you get into this, the more complex and the more sophisticated you have to become. Maybe it pays here, I think, as we talk about these kinds of product, it might be interesting as you as a banker can talk about some of the interesting things people have done when they told you they're conservative and then they build a bond portfolio, or then they build a stock portfolio. I think that what people think is that stocks are a little bit more risky and bonds are a little bit more fixed income-y, but I'm sure you've got a few scenarios where the bond portfolio turned out to be as risky as anything else you could put your hands on.
Yeah, exactly. You mentioned before the rating aspects like AAA or CCC. I mean, you don't want to be in CCC area unless you love risk and you're willing to potentially lose money. Why? Because CCC is close to is considered high yield, high risk bonds, and therefore even without going to CCC area, even with even single B, that's also kind of risky. So what it means is that you kind of like invest in bonds with a company that is highly levered, that's got a lot of debt, that is potentially I would say dangerous in terms of investment. It's just like risky investment. And this is something that some people need to take into account. You get a nice coupon, very high, but at the same time, high return, high risk. That is very, very basic, rule in finance. So this is why you need to make sure that you build your portfolio with the right level of risk. Stocks are risky, obviously. Again, some stocks are much riskier than others, but still it is considered equity and therefore relatively high risk. So need to take all these kind of things into consideration. You need to understand what you put your hands into.
And then client comes to you and says, I want to have stocks, or I want to have bonds. Is the first instinct to kind of say, what do you like? Or is the first instinct to say, let's look at a couple of different funds where you can get broad market exposure to things that you like? And so as you look at how we look at a standard product, What is the kind of what do you think the client base is looking for when they hear this kind of product?
Well, first of all, we need to understand how the client is educated about funds and ETFs, because some people are just not huge fans of putting their money in an instrument that holds many different stocks or many different bonds that the client would not be seeing and touching. So some clients prefer have a portfolio with a lot of lines, with a lot of positions, because they know what they hold. So sometimes we have to make sure they understand the difference and they feel comfortable with the difference, so that our advice can actually make sense. Again, it's very psychological, but our role is to help the client understand the benefits of each instrument, and then together we decide what to do.
There's a lot of talk right now about AI, and also there's a lot of talk in other fields like Dr. Google. So you feel a medical symptom and you type it in, and obviously you get the worst case scenario, and you start to think that you've got illness X, Y, and Z. Are you seeing with clients, they've gone and they've typed into AI,
Yes.
give me my top 3 picks, and then they come to you and they're like, I gotta buy this. It just came out of Gemini, or it just came out of
Yeah.
ChatGPT. Do my
Absolutely.
portfolio.
It's a very timely question. A client sent us money. We obviously now have to decide on how to invest that money. He knows that he wants to invest in a certain amount of stocks. So far, so good. We've provided a list of stocks and recommendations how to build this portfolio. The client wants to cross-check it. He's got 3 different AI models, like some AI models that I don't even use.
He built them himself. Is he a
And-
tech entrepreneur?
So he's extremely techy. But what happens is that he's been working on that for like 2 months now, and he hasn't come back to us. He wants to check more things, and eventually he's missed 2 months of positive market performance. So I'm sure those models are good and provided like good insights about the stocks, but eventually the money has been sitting on cash for this time, and that was a funny anecdote. So the answer is yes. Some people are coming with a list of stocks. Another client came up last week with certain stocks with certain characteristics. So he put in the model the kind of like characteristics he's looking for. Stocks that came up like this, like that, came down, and this is the volatility. So put me a list of stocks that I want to invest in such a way, and then he sent us the stocks list on which we have to build some product. So yes, people. The more the techie population is slightly more active with those AI models. We need to be careful. I mean, we need to cross-check this information, but yeah, we see that more and more.
This was, I don't know if we are still using the term ESG
We do.
as an investing theme, but I think, look, there's always been this tension. We used to call them, because I'm older, we used to call them the sin stocks, where you would try and avoid the stuff, but people would buy tobacco and big oil and coal miners, and they would pretend they didn't own it because they were kind of against it in theory, but that's where you were making money. What's going on with that kind of investing right now? Or is it something which is still prevalent? Are we hearing less and less of it, or is it something that's just not on our radar right now?
Well, some clients, to be fair, some clients don't really care. Some people are very, for them, it is a clear requirement. Obviously now this is a theme, the impact investing, ESG investing, green investing, all these kind of things. I think we are equipped to show the right categories and be able to show clients some investments, some instruments that fit those requirements. So we have the occasional client that is actually really keen to see that. I would say a lot of them are less regarding.
We hear a lot, and I'll end with this question on this topic. We hear a lot that there's a difference generationally. And there are a lot of numbers being thrown out there these days that this is the largest wealth transfer you're going to see over the next 10, 15, 20 years, and it's trillions and trillions of dollars. It doesn't matter who you ask. And then you'll see these consultants get up there and talk to us about the difference between the boomers, the Gen Zs, the millenniums, the alphas. I probably got those in the wrong order. Do you think that's real, or do you think people are really just interested in the same thing, which is long-term financial security for them and their family?
I think we do see a difference in the behavior with regards to their investments. I think this is clear. We talked about it in our investment forum recently. I thought it was fascinating. But yes, we need to take into account the psychology around investment, medium term versus long term. I think the perception now is different within, between some people who grew up in the 50s, 60s rather than, people who grew up in the 2000s. And it's something that we need to take into account. But again, um, uh, uh, there's no right or wrong. We just need to adjust to the population we're talking to. Again, with the right level of advice, I think we can do anything. But yeah, we see a difference in mentality.
So we've covered the standards. The standards, and I would say the standards are stuff that we own.
However, sorry, I'm thinking
one
of
more.
something. I'm talking to a 70-year-old client who thinks that he's 20 years old. He invests in stocks day in, day out. So anything is possible, really.
He's got a high risk. He's got a high. We learned that term last week, which is spending the kid's inheritance. What's it called?
Yeah. Yeah, I forgot about it.
We
But
learned
yeah,
that term last week. I forget what the acronym is.
yeah.
Alternatives. You hear this and you're like, what does that really mean? And so, you hear alt rock. You hear about a lot of different alternatives. So let's run through a few of the alternatives. And obviously, not advice where clients could be, but these are the terms you're going to hear, and maybe we can describe some of the differences between what this is. So the old traditional hedge fund.
Yeah, so alternatives is a big box that includes a lot of things. That includes hedge funds, private markets. So private markets is private equity, private debt, these kind of things, infrastructure, real estate, commodities. This is the kind of things that you would put in the alternative investment box. The idea of, for example, hedge funds and private equity, private debt, is that what we say the correlation to the market is lower, meaning that if you have a very big market move up or down, those instruments would not be necessarily moving in the exact same direction with the exact same pace. The volatility, like the way those things are moving, is very different than the volatility of stocks, meaning that stocks can go up and down very quickly. This is generally speaking slightly, a little bit more stable, and those are the things we tend to see. Now, those products are not trading necessarily on a daily basis. Some of them are, but let's focus about those which are not trading on a daily basis, meaning that in order to buy or sell, sometimes it can take a month to buy, it can take like 3 months to sell, to redemption, meaning that I need my money, I put a sell order, I will get my money back in 3 months, 6 months, sometimes maybe longer. And those products are supposed to, in theory, give you a premium, which is what we call the illiquidity premium, because it's less liquid. A stock is liquid because it trades day in, day out. Those are not as liquid because it takes more time to get in and to get out. So you need to be careful with that. However, they bring very interesting characteristics in terms of risk and return. And this is a part of the portfolio that is increasingly seen in clients' portfolios. Now, there is also an interesting thing that's called semi-liquid funds. What is a semi-liquid funds? You may think of a private equity fund where you invest for like a 10-year cycle. The semi-liquid funds are things that you invest from day one, and then it takes you, as I mentioned, 3 to 6 months to get out sometimes. And therefore, this is why it's called semi-liquid, because it's not extremely liquid, but it's not also totally liquid like a 10-year investment. So this is extremely popular with investors because it is, I would say, a medium-term kind of like investment. Can be long-term as well, but clients are happy with the fact that it wouldn't take years to get out. That's also...
So it sounds like, let's take a step back. Alternatives, and we talked about this a little bit in a prior episode, are going to be a little bit less liquid. The return profile is different, so perhaps they're considered more risky. We can debate whether that's true or not. But also, I think for most of these alternatives, we're going to come back to those definitions of qualified or eligible investors. And so these are not products that are open to everyone. Though in the United States, at least, there is conversation about putting some of these product into 401ks and long-term investment vehicles, because even though there is long duration, if you're talking about putting money away for 30, 40 years, it might be the perfect match even for non-qualified investors. And so I think that that's something everybody has to be thinking about. Maybe let's just talk about a couple of different kinds of hedge funds, meaning in each of these categories, you could also get different exposure. You've got tech hedge funds. You've got long-only hedge funds. You've got long-short portfolios.
Yeah.
You've got macro guys who are looking at currency and economic trends, broadly speaking, and are taking very different looks on a lot of different parts of the economic cycle and are not even touching your generic stock portfolio. And so, I think here too, you hear about a hedge fund, you have to think about what kind of exposure you get and not just use that general overall category of, oh, I'm putting money into a hedge fund, that's what I want. You have to be thinking about what kind of exposure am I looking for and what kind of style am I looking for. So I think alternatives has a lot to do with style,
Yes.
even more than it has to do with actually what you end up buying.
Yes, because eventually, with a lot of hedge funds, you don't know what they invest in really. So more or less, what style. Some of them are investing in equity, some of them are investing in rates, some of them are investing in currencies, some others like in the macro theme. All kind of things. Some of them with algos, like automatic trading. It's a whole world. So indeed, when you select hedge funds, I think you have to take into account the theme, the style, and obviously the manager, because eventually you're going to trust the manager who is going to run that hedge fund. So what's his track record? How has he been doing? What's the strategy? And the teams that are selecting the hedge funds in our platforms are, monitoring very closely the hedge fund managers, the track record, the performance, etc., etc. So there is constant monitoring, because what happens if a hedge fund manager leaves the firm? Who replaces him? It could be a totally different, he can change the whole thing. So this is why monitoring is extremely important.
What kind of trends have you seen over the last, you've been doing this about 10 years, even locally, in private equity and private credit? Because if you think about those were smaller slices of the market. I think we're talking about some things that were 2-3% of the market, and other much, much larger pieces and growing of the market. Are you seeing different trends and different client kind of expectations, knowledge, activity in the private equity and private credit worlds?
I think we've seen an increasing amount of private equity and private debt exposure from the big managers, because they've seen demand in those assets. I mean, we think about there were certain times where the rates were extremely low, so clients were not really getting income from the regular bond market. So when you go to the private credit market, you can actually get some interesting income. What's private credit? Private credit is companies that need to raise some debt, but they cannot get it from banks or from the public market, from bonds. So they go to private to group that actually lend them money according to certain terms, and that market has been growing really and offering some interesting returns. So this is something that we've seen increasingly. And the second thing that we've seen is, again, what I mentioned before, is the growth of the semi-liquid funds, because it is quite comfortable for clients to invest in funds that they can redeem in a reasonable period of time.
You mentioned real estate. So everybody, I think real estate's one of those things where a lot of people own a home or an apartment, and it actually turns out to probably one of their biggest investments that they're not even thinking about. But then we talk about real estate as a market. Just talk about how different clients are getting different kinds of exposure to the real estate market in a way that we would call alternative.
So obviously, real estate in Israel, it's something that's pretty strong in Israeli culture. People like to invest in real estate. So what do you do once you've invested in an apartment, or let's go bigger, in office buildings or in commercial centers, like we see with some of our clients? And here, I think those people who believe in real estate want to also get diversified their exposure with global exposure to real estate. So in other regions, because there are some interesting opportunities. So here, sometimes what we do is we see investors investing through funds. So those funds, you invest in a manager who has the right contacts, the right capabilities to invest in certain asset class within real estate. It can be like multifamily, it can be commercial, it can be data centers, it can be, and that is requires certain capabilities that only big fund managers have, and they also have access to the right level of deals. And therefore, we see a lot of people investing in real estate through those managers. So putting money in the fund and say, okay, US real estate, I'm not, I cannot do it on my own. So let's put money into this fund X, and then they will do the job for me.
In the local market, we talk a lot about, everybody here knows about the venture community. I would say that from a private, I'm just going to take some of the things we've talked about. One of the things you're not going to hear us talk a whole lot about is venture. I think all of our clients are interested in venture. We know a lot of VCs. I think there is a lot of activity and a lot of excitement in that area. But two of the things that you talked about make it a very difficult product for us to talk about a whole lot in terms of specifics, and that is liquidity and duration, which is these are the least liquid and longest term investments you're going to make. The money is locked up. The average time to IPO is extended. And so clients who put their money into VC have to understand the hit rate of VC investments, which is disproportionately geared towards hitting home runs, to use the baseball analogy in the United States. And also, you have much less control about where about how the manager is going to be using your capital. And so I think that from our perspective, we hear a lot about VC investing. A lot of our clients do it, but it's not something which is a standard product that is on most private banking platforms. Well, let's talk about something that it is, which is, gold last week. Our own CIO called it the Mag 8 because it's performed like a tech stock over the last couple of years. And so when you think about locking in gains or doing things where you kind of have a negative or a positive view on the market, but not enough that you don't want to lock in some of your capital, let's talk a little bit about what a structured product is and how some of our clients use them.
Well, very broadly, a structured product is a product that allows you to get some kind of exposure to some kind of asset class with some kind of downside protection. So I would say there is a whole world of structured products which has been extremely evolving in an exponential manner over the last few years. But putting it simply, it allows you to get partial or full downside protection in a certain asset class. Like it can be any stock, it can be any index, it can be on gold, it can be on anything really that is relatively liquid, and you can enjoy partial upside, and or full upside sometimes, or leveraged upside. It can be enjoying the benefits of the upside of this asset class, or a basket of different products with certain downside protection. So obviously there are some things to take into account. The structured products are issued by an issuer, and this is the risk you have to also be looking at. Who issues that product? If it's a bank that is going into default, then you're in trouble. So that's why it's important to pick structured products with good rated, highly rated issuers. And therefore, the structured products obviously sometimes would not necessarily allow you to benefit from the whole upside performance of the stock, for example. So you may miss part of the performance. You need to be ready to kind of like, there's a trade-off between upside exposure and downside exposure. So you can sleep better at night, but at the same time you may miss part of the party. So those are the things that clients need to understand.
What's the real profile of people who use structured product? Is it people who are very market savvy? Is it people who are a little bit more nervous about the market? Is it a broad range? It feels to me like this is a product you hear. I think sometimes they're called derivatives. It's something that you hear, and I think applicability is something which is something we always have to think about, which is, do they come to us? What's the, I don't think there's a percentage you would ever put on this should be in your portfolio. And so I think the question of how you use them is pretty interesting.
Yeah, so there's a broad range of client types that invest in structured products. There are some clients which are extremely conservative and ask for what we call full capital protection product. Obviously, always read the disclaimers, read the term sheet, etc. But those clients want to sleep well at night, so they know that their only risk potentially is the risk of the issuer going into default. So that is something. Some other clients are a little bit more risk takers and are happy to go with some products that we will, for example, pay you a high coupon, but there is a level of risk to take into account. Some people also, for them, it's comfortable to use structured products because they cannot build those products on their own. As you mentioned, there is a derivatives angle, to take into account to build those products, like options and all kinds of things, which, as like a regular investor not trading options day in, day out, he would not be able to build such a product. So it's kind of like comfortable to have it in a portfolio in some cases. So we see really all sorts of clients. Some of them, have in mind, what happened in 2008 when structured products actually, despite some downside protection, led to significant losses. So we have to take into account, really the risks that are involved with that.
So it's one of these headline terms, and it's something you should use. You use at discretion, just like most other product.
Yeah.
I just read a great book, 1929, about the crash. These are things you do when markets hit peaks. Not that I'm worried about that, but I do think it's always interesting to look at history. And if you go back in time, one of the things that people talked about as being part of the reason that the crash happened is leverage. Mm-hmm. Too many retail loans. People had leveraged their portfolios and had ended up when the market came down, owing the banks way too much money and caused runs on banks and all kinds of other things. I'm not the expert here, so I'm not going to talk about the Depression. But we hear a lot about leverage. We're not going to go into all of that, but talk about how, why, and what some clients do with leverage in the markets these days.
So clients are using a tool called Lombard loan. So Lombard loan is a loan that the bank gives the client using as collateral the client's portfolio. So there is all sorts of rules how much loan can a client take. So there is what we call the LTV, loan to value, which is how much for each product is the lending value. So for example, I have $1 million in the Apple stock, and then the LTV, for example, again, it's an example, it's nothing binding, but let's
in any stock, not the Apple stock.
Let's call it 60%, for example. So for example, I own $1 million worth of Apple. The LTV can be, let's call it $600,000, okay? Subject to diversification in portfolio, subject to many things. Again, subject to approvals, etc. So what can I do with that money? So with that
First of all, why would you want to do this? Would you want to do this? I think, why would you want to take this loan? Risk or protection? And what I mean by that is, are you taking risk because you want to buy a lot more stock? Or do you want to protect your core holding, but you want to take advantage of opportunities? And is there a difference in how we think about that?
So the clients, we usually take loans because either they have a specific need, they want to buy an apartment and they want to use that leverage because maybe it's cheaper for them to take a Lombard loan than like a mortgage. I don't know. It can be an option. The other option is because you want to invest more, because you look at the loan and you say, okay, lease loan is going to cost me whatever, 4%, 5%. Okay. But I believe I can make more than that, a higher return with the money. So if I get this money cheap and I make more return out of it, it sounds like a good deal. So if clients have a good conviction about this, this is what they want to do. Now, obviously there's risks involved. If the collateral we're using in this example, the Apple stock, is going down significantly, then you run a risk of your lending value is being hit, and therefore, you're going to be asked by the bank to inject more money in the account, because there will be what we call a margin call. So you don't want to be in that situation. It's not a nice situation to be in when the bank calls you and tells you, look, you have very limited amount of time to bring new money into the account. You don't want to be in that kind of trouble. So this is why loans need to be used very carefully. Always leave some kind of like a buffer, safety net, however you call it, and therefore clients need to take that into account. And this is why also we help them kind of like monitor the situation. So again, it's not for every client. But this is something that is being used by some clients, yes.
Yeah, I would say this is a tool. You've probably heard about this tool. It's not a tool that we are recommending. It's a tool that comes in, and it's like any other tool. It has to be used appropriately in the market under the right conditions, because tools can cut both ways. Look, I think we've covered a lot of different kinds of products. I think we've explained a lot of different product. Hopefully it's not too detailed. Obviously, there's no advice here. We're not telling you to use any of these products. It's all dependent on your portfolio, your risk appetite, and your time horizon. But hopefully this helps you understand some of the different things you can do when you come into the door and think about the supermarket of financial products.
Thank you, Joseph.